All right, the market finished what was pretty much a lackluster week with a bang. A really good return today, and the S&P had a pretty decent return and almost finished with an overbought cluster. But the big winner today was the Russell 2000, up nearly 3% higher today. Big move higher. A lot of it on comments from earlier this morning. Really, a lot of it was from yields falling, and a lot of it from comments earlier this morning from the Fed chair. Fed Chair Powell, even though the comments kind of pretty much kept the interest rate cuts off the table, the futures market's not believing that, and the stock markets are really jumping on what those future markets are pricing in. As you'll see, as I show you today, the stock market's jumping on that a lot more than any of the other markets are, and we'll talk about that and take a look at some of the now that we're 5 weeks into this rally, kind of putting that move into some context. With other 5-week consecutive weeks to the upside, with 4 of them being 1% higher move. So significant move. There's some precedents. We'll take a look at that and what it means. And we'll also break down, what's driving a lot of this action in the early part of this 5-week rally, and then of course in the later part of it. And then our trade idea is a stock that's kind of making its own little breakout pattern. In a catch-up mode. So we'll talk about, kind of like the Russell 2000, we'll talk about how to trade that stock that might be trying to catch up to where the S&P and the NASDAQ in particular have already gone. So let's go ahead and get started. Today is Friday, December the 1st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click on the heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. You can hit that like button there. Again, you'll notice as the first comment on the videos, our Cyber Monday sale here goes to the end of this week. So through Sunday night. So you can check that out here over the weekend. Clicking that link there to get more details about the offer. You can also get more details about what we offer for our premium subscribers. Again, the 20% off of that puts it at roughly about a $78 per month average. And that's about 40% less than what our Plus subscribers pay on a month-to-month basis. So, and you get all the additional features for premium. So it's a very good sale that we only offer on Black Friday. So you can be able to check it out here and be able to use this button up here at the top to be able to, if you click on that button there, it takes you to the page where you can be able to sign up, again, using the Black Friday coupon code that you would come down to the bottom here after putting in your name and information where it says have a coupon. You can type in Black Friday right there, and that gets you the discount. All right, let's take a look at the S&P 500 with the market forecast indicators. You can see we finished the week pretty much at the high of the week, right on a significant high note, to the point where we almost actually got an overbought cluster. Which again, we almost got over here as well right before the CPI report. Just a little off of the high that day, or we would have gotten one. But again, we are at the 76.5 percentile. That's the that was all that we were missing to get there. In fact, if you notice, these two lines are right next to each other. The one line on top is the high of the year. This line, of course, is the current high. In fact, the high that we just closed at 45.94 is higher than the high of the year at 45.88. So it's not a 52-week high on an intraday basis, but it is a 52-week closing high for the S&P 500, over 4.5% above the moving average, still strongly above. And again, the near-term line easily in bullish territory on a new near-term rally. Again, that was after a 20-day near-term increase. That was our near-term decline right there. So again, it did not even get close to the 23% retracement. This is the Fibonacci's are for the current intermediate run, but this is only the beginning of the second near-term leg of this intermediate run. So, and to almost finish with the cluster is pretty significant there. If you look at, again, it was more broad. As you can see, the NASDAQ did not finish nearly as strong. Look at its short-term sentiment lines are both down. Its market sentiment line is in the upper half of the chart. The intermediate line still strongly bullish. So not nearly as strong in the short-term sentiment. It was the Russell 2000 that blew things away yesterday, almost 3% to the upside. Now, again, remember the S&P 500 is sitting right here at the 100% line. So we had a 3% rally. Like this was below the 50% line going into today, and you had a 3% rally on the Russell 2000. That is a significant move, and it also almost finished with an overbought cluster again at the 75th percentile, not the 76th, and now 7% above, which is in the 89th percentile. Only this move over here where we got 9% above. In fact, if you go back, let's say like 5 years. Just to kind of give you an idea, follow my cursor along, you can see getting this far above the moving average is pretty significant and we did, if you notice, like back here in November, we did have a pretty singular move on the Russell 2000 because we have been so sideways. We had kind of a breakout move over here this week of the last week of October going into the early part of November on the S&P in 2021 that you really didn't get. Let's see, it would be over here. No, excuse me, right here. That's the same move on the S&P. So very similar pattern where you were already pretty bullish in the S&P, so we kept going pretty bullish there. But the Russell had been lagging behind and finally broke out to catch up. Well, now it's the the S&P had already been bullish, kind of staying bullish, a little bit more bullish there too. But the Russell, which has been so far behind, is catching up to a significant degree. To the tune of being so far above its moving average. That's a pretty extreme level. This is now, again, that was the CPI report, and we were already pretty behind there, and we caught up a little bit but didn't go anywhere, and here we are again catching up. In fact, if you look at the Russell 2000 on those days here, so there's the S&P and here's IWM up over 3%, and that's the day of the CPI report. It was up over 5.5% on a day where the S&P 500 on November 14th, was up 1.94. So big dramatic move on the Russell again, similar to what we just saw today or Friday here, yesterday. And this is not, again, we had a 3% move. That was up over a 5%, almost 6% move, 5.5%. This was a 3.5% move to the upside in early June. And you notice the implied volatility for the IWM is way below the historical volatility, which is very uncommon. Again, usually implied volatility is a lot higher, or not a lot higher, but tends to be higher when you're bullish than historical volatility. And then generally at the end of these moves, you can see going into that the end of August there, when we started to get bearish, part of the reason why is because historical volatility was higher there than implied volatility. So it's uncommon to get that gap there in the wrong direction. But again, the reasoning is because of what happened. And you also saw that too, to a degree on the Dow Jones, which blew away in the last 2 days, these highs from July. Just complete blowing away. Again, no cluster, over 6% above the moving average, which is the highest of the past year. So really significant moves. And again, if you look at, I've shown you rate of change. Let's go to a rate of, so we just finished a week. So let's go to a 5-week rate of change. A little different than looking at this normally. Happens to not be 25 days because we had a holiday in there. So it's 24 and a half or 23 and a half days there with the Thanksgiving. And then you look at, again, we were up for the S&P, we were up 11.5%. Ended up being 11.59%. So kind of right in that area there. It just needs to be up just a little bit higher. So 11.59%. That's the last 5-week return. So you can see how uncommon that is, right? Especially when you're not washing out. Like the times that have been bigger than this, we're coming off of significant volatility peaks. However you measure volatility, obviously we did not come off a volatility peak this go around. But that's the S&P. If you look at the Dow Jones, it's up 11.8%, which is also a big number. The NASDAQ 100 is up 12.8%, which is not, we've had these numbers before. We had it last August, we had it last November, earlier this year. We had not so much in March when we had that big peak in March there, and then finally your Russell 2000 up 13, almost 14% in 5 weeks. And again, you can see how extreme that is. Big move to finish off this week, this 5 week, as of right now, a 5 week period. And as someone mentioned before, when you look at how often, like the S&P 500 has been up 5 weeks in a row. So here we are going on 5 weeks in a row. If you go follow along here, there was a 5 week in a row. We didn't make it to 6. There's a 4 week in a row right there. Here's a 5 week in a row. We had that followed that up with 4 weeks to the downside. That would have been back in COVID. At post-COVID, there was 5 weeks or 6 weeks in a row. In 2019 was the last time we've had 6 weeks to the upside. When was the last time we had 4 weeks in a row of 1% gains or more? Again, that was October 2021 was the last time, November 2021, that we had 4 weeks in a row of 1% or more. And, we had a small down, small up, but then that's kind of what started a lot of that correction over there. So needless to say, and again, its weekly implied volatility is below its market sentiment. That's usually not the best sign for the markets there. But regardless, a strong move and a strong market forecast and flirting with new 52-week highs on the S&P. If you look at the long-term chart, you can see again the candle. The size of the candle is smaller, but it's just barely smaller than the average. The average is still pretty elevated. And it's going to get smaller because the candle, like the body, we're going to open at 45.19 next week, and we're trading right now at 45.94. So we're going to get even smaller on the bullish body. So we're going to be susceptible to a transition candle next week. Despite how bullish we've been, we're going to be susceptible to that. You see that actually on the whole, on the daily. So here's the daily whole, and you can see we've been bullish on green for quite some time. Only one day to the red, but we never did flip the parabolic SAR to the upside. We never did flip below this 200-day, the moving average of the 200-day MACD. And nor have we now, with a new candle, broken back out above this 2.5% mark. So we're still kind of in convergence mode when you look at it from that perspective. Of course, you are back. You are convergence mode here too, because the S&P and the NASDAQ have a red arrow on the MACD. Your Dow, of course, and your Russell, because they were so bullish the last couple of days. The MACD actually turned back up before getting a red arrow. When you look at the 3-line version of this, you can see the convergence. The MACD is below its moving average. We're still above the 8-day. That's convergence. You look at the Qs, you're below, the MACD is below its moving average. You're still above the 17-day and the 8-day for that matter. That's convergence. That's what the convergence that you're seeing here. And when you look at the DMI, this is what's also really telling. If you look at the DMI, it's a very strong pattern. Like we've already had a really good bullish pattern this year. If you zoom out a little bit to see how bullish this is, you see how uncommon it is for the, over the past 5 years, how uncommon it is for the ADX to get this high. There's been a few other times you look way over there in 2020. I got higher than this pre-COVID, but pre-2019, in the middle of 2019, we got this high. And of course, here earlier this year, you got really high with the AI craze that pushed that up there. So here we are again, twice in the same year. You're getting a move above 35 on the ADX. That's pretty uncommon, to the point where you can see the weekly got pretty strong earlier, and right now you're above 30, and you're still not quite below 20 yet on the negative indicator. So we'll see how that plays out. But what I wanted to show you here is kind of even more extreme. I'm going to cut the DMI in half so we can see the short-term DMI, and that is extreme. We are nearly 65 on the ADX. That's insanely bullish. Again, you have to go back pretty far to see another instance of it being that aggressive. You have to go back to the post-2020 rally there. Here, let me zoom out a little bit. Let me put some more data in so you can kind of see. You have to go back to that almost the pre-correction here in 2021. That same 4-week period we talked about or before of 1% gains or more. There's that parabolic peak right there coming off of COVID. And then you can see in 2018 we got pretty high on the ADX as well as 2017. So here we are again with this extreme parabolic move. Look at all these arrows down here at the bottom with the negative indicator. Again, parabolic moves are great. They last longer than anyone expects they would. As again, nobody expected we'd go up this much in 5 weeks. And literally, even people who thought we'd be at 4,800 by the end of the year didn't think over the past 5 weeks it'd be this bullish, because the market didn't. It's a 2 standard deviation move even to the options market. So otherwise, they would have priced that kind of move in. If the VIX would have been a lot higher, the ATRs would have been a lot higher. And there wasn't. So it literally has, the bullish move wasn't unexpected at all. As the extent of it, that was the unexpected part of it. And you can see just, how parabolic moves can go longer than you expect that they would, but they don't consolidate sideways, as you've seen on all those other examples. They don't consolidate sideways. So here we are back above 100, but we still have never crossed above the 150 mark in the CCI, and we're back to an extreme peak on the RSI. And you can see on the weekly version, the RSI is above 60. It's not as extreme as it was earlier this year on the weekly basis. And you are above 125, though. It appears that the peak is slowing down. Again, not getting back above that one, but at least it's above 100, so it starts a bullish pattern. That's why it's green there. When you look at the Ichimoku cloud, way above the cloud, you have a mature trend going. So now we're going to be watching for it to break not the blue line, but the green line. That's when you start to get, when you have a big gap between the blue and the green, which this is one of your bigger gaps that we've seen in a while, right? I mean, look back over the past few years. You can see the gap between the green and the blue. This is a log scale chart, so that's one of your bigger gaps. You have to go way back to see a size of it. Again, coming off the COVID peaks, you had about that kind of a size of a gap, and you were below the cloud at that point. Here, you're well above the cloud, and there's a huge gap. And again, when you break the green line, you can fill in the gap to the blue line. That's kind of how this works. And your rate of change is extreme as well. Again, looking at the rate of change, like we just did, right, over 24 days. This is 24 days. This is 26. So even if we were flat over the next couple of days, it would be the biggest 26-day gain of the past year, and be one of the biggest 26-day gains of the past. We have to go back to this move here to get a bigger gain over 20. To have this, so in other words, the size of the rate of change over 26 days is how high the red line is above its close, right? Above its, this from the close of the candle to the red line. So it's one of the higher ones that we've seen. So very similar, right? Very similar, very extreme. What's interesting is the Bollinger Bands were extreme on a bullish move, no less. Not as extreme. In fact, you're in the upper quartile barely. You're still not, but you're definitely not in the 90th percentile, like the upper extremes of the bandwidth. Your momentum is still declining. You are above the Keltner channel. You haven't broken below the Keltner channel yet, but this is one of your, kind of an interesting move. The bands are still, despite the rally, the bands are still moving towards the Keltner channel as that momentum is moving back towards the zero level there. If you look at today's intraday move, of course, you did get a new, you did get a new 4-week high point, right? That's not surprising, a new 4-week high point there. You did bring, it didn't help too much, the 4-week range. It's still below 6%. So unless we keep pushing this up significantly higher, we are dropping. And in fact, by the end of next week, we will move up. It will move up, over, but not this next week, but the week after. You can see it really starts to move up quickly. So unless we really push the range up, the range is going to come down pretty sharply. That's what it does when it gets to these peaks, right? Usually these peaks don't make the bandwidth go higher. But as you can see, when it did here, eventually it came down as we went sideways and stayed down and then turned bearish because of that. So that's kind of what we're seeing. Again, remember, parabolic moves don't consolidate sideways, generally speaking. Obviously, today's volume and trading range, the range was still was above average, 4.49, above a very small average, and the volume was above average. But as we've mentioned before, that ATR is down below 1%, it's below 0.9%. So it's down to really, really low extreme levels and appears to be like kind of halting that decline. So kind of, extreme lows. And then of course your VIX and your VIX is down below 13. It's kind of gone sideways all week despite the rally today. The VVIX went up. So over the past 10 days, look at the correlation. The correlation for the VVIX is below a half, negative 50%. That's crazy because this is normally a very strongly correlated series, the VIX and its volatility, the VVIX. So the fact that it, when it gets this low on a negative correlation, it typically precedes a bounce in volatility. That means you can see how you had a couple bounces here. And then over here you had the bigger bounce, a couple bigger bounces. And so again, you see this gap between the VVIX and the VIX. That gap usually gets filled by the VIX catching up to where the VVIX is to the upside. So again, kind of a suggestion that that we've been very extreme in volatility, in this case to the downside, and that extreme is probably, if you notice, we're consolidating, we're converging on the VIX as well. Like that extreme, we're not going to get more extreme on the VIX as we're already like converging here. The momentum move to the downside is done, and now we're changing directions. What you would expect here sooner rather than later to the upside. If you take a look at what's driving this price action here, let's take a look at let's look at today first, and then we'll look at the rest of this week. So let's go to December. I'm gonna go to December 1st. All right. So you can see big 3% move higher. IWM, real estate, big move higher. You can see gold was up with weakness in the dollar. And then bond yields were down. The fact that the dollar was down, commodities were down, and yields were down, big move, especially now the Qs didn't rally, which is kind of interesting. That is IWM that really took off. If you go back to the full week, again, you can see kind of some changes. I need to go actually because of the holiday. Go back over here. Again, you can see, look at gold. Look how strong gold was, a 4%, including Friday's move over there. And that's a big move higher. Again, a lot of it's the dollar weakness, but the Qs were flat as a pancake, despite a nearly 4% increase in IWM. Now, granted, a lot of that increase in IWM was since today's move that made it rally so higher. So, very fascinating move, and a lot of it is this drop in yields, which dropped again down to 4.22%. So we've broken below this week. We broke below the Fibonacci, 38% Fibonacci retracement. We're filling in the gap between the 50 and 200-day averages. The 200-day average is down at the bottom. Your MACD, remember, your MACD histogram has already peaked. We haven't converged yet. We haven't, the histogram has been declining, moving towards zero, which is that first stage of convergence. But the MACD itself has not crossed above its moving average yet, which is that second stage. So you're still on a pretty steady decline, looking like we're trying to get to this 4.2% mark, the 50% retracement. Your dollar, as we mentioned, also had a really rough week. After a couple days to the upside, it was back down again today. Its MACD did cross barely above its moving average, as we had dipped below this week the 200-day moving average, and are still below it despite a rally lately. We're still below it and flirting with that 8-day moving average. So you can see how what's driving this, and you can see how the commodities breaking below the 200-day moving average. The MACD is trying to figure out what it wants to do. You're around the point of control. It's like, okay, we've had a really good run on these three things that have all been bullish for equities to different degrees, right? During some of this 5-week period, if I go back to the whole 5-week period, it hasn't all been the Russell 2000, right? It was initially that the strength came from in the Qs. So if I were to go back to when this whole thing started, so here's that 5 weeks that we've been so bullish. There's your drop in yields with TLT being up 10%. There's your drop in the dollar being down 2.5%, and the UUP being down 2.5%. And there's your drop in commodities being down almost 5%, DBC, down to the 200-day moving average, down to the 50% retracement on TNX, and the dollar also moving lower. You can see gold didn't rally away from commodities until the end of this run when the dollar was at its weakest. Then you can also see too that originally it was IWM, then it was the Qs that had a big outperformance over IWM there. And you can see IWM caught up on the CPI data, and then the Qs outpaced again with a pretty decent gap until today, and then now IWM has actually outperformed over the past 5 weeks. So there's that catch-up trade that we've had. Now keep in mind, again, going all the way back, and if I were to go back to the peak, the July 31st peak, so the bearish move, and then now the subsequent rally. If I were to go back here, let's go to July 31st. Well, actually, we go August 1st, because July 31st was the highest close. Up until now, again, you can see the Qs have been, they're the ones that are above those highs. The Dow, remember, has blown away that high. The Russell 2000 still about 7% below that high. So again, you can kind of see why it's playing catch up so much here. And look at bonds TLT during that same period. TLT is still down 7% over that period, even though, again, the Qs are at new highs. S&P is at new highs, slight new highs since that time frame. And the dollar is strong during that time frame. So as bearish as we were, and then the subsequent bounce, like what caused the bearish move was not completely erased that to cause this rally. Like, again, what got us down to this point here, you can see, was a drop in bonds, so a rise in yields, a rise in commodities, which was higher at the early stages, and especially a rise in dollar. Well, from that low point to now, we are back. The dollar's not back down where it was. Bonds are not back up to where they were. Commodities are down from where they were, but you can see we're down actually a little bit more over here during this time frame. So it's kind of interesting to see that we've had a much bigger response to the upside in the past 5 weeks, which is kind of what you expect. It's been such an extreme 2 standard deviation move that we've had such a bigger response in the equity market than we've had in any other market to the same stimulus, right? To the same idea that, and really what's driving it continues to be this idea that the Fed is going to cut rates. If you notice now, there is a 90-some-odd% probability that by June the Fed is going to cut rates, right? So we've really ramped up the rate cut odds for next year. You're a 98.4% probability of a rate cut by next June. But now if you go to March, you have a 60%. In fact, it's a 63.4% probability. So that's a high. Once you get above 60% now, you're at a high probability of rate cut odds by next March. Again, higher for longer has been the mantra, which has been repeated and was even stated on Friday that they're not even looking at rate cuts yet. And yet the market kind of says, you know what, we think you are, right? Because you go back to a week ago, you have a 63% chance now of a rate cut. You only had a 21% chance of a rate cut in March a week ago. It's a very low probability. You have a 99% chance, but you had about a 70% chance a week ago. So you've really ramped up the probabilities in this past week. And the stock market's the only market that has responded way more aggressively than any of the other markets. It's responded way more than the dollars responded obviously way more than the yields have responded, and responded way more than commodities have responded. It's been the stock market that's made such a tremendous response, again, to the same, in this case, the same stimulus. All right, so our trade idea today is on Caterpillar. As you can see, Caterpillar, like most everything here, especially in the industrial complex, turning bullish, closing above these highs. Dark green shading, the green line. You don't have a cluster, though short-term sentiment's pretty strongly bullish there. The momentum line has not gotten to the reversal zone, even though the near-term line has, and you are 5% above. But you do have dark green shading, the green line for the first time in a long time, right? Since this whole decline started. Remember, it started on July 31st here, or August 1st was the July 31st was the highest close for the S&P. Obviously, Caterpillar had earnings that day. It's had its highest close the next day. We've been in the decline ever since. So, but you got the bear tag. We've continued higher. We've gotten 5% above. It's got a bullish reversal pattern on its weekly Hakinyashi candles. You can see we're bullish here. We're getting higher highs, higher closes. You got the green arrow, which means we're closing above the 10-week exponential moving average. The PPO is starting to turn up higher as well. So that's a good sign from that perspective. Looking at the 3 green arrow chart, you notice we are above the 50-day moving average and the point of control and the value area, the top of the value area. So MACD is positive and rising above its moving average. So Stochastics is in bullish territory. So really good bullish, like we filled in the gap and now we're breaking through that 50. It's a good sign. The 8 and 17-day moving averages, you can see, have already crossed above the 30, as well as the 200 for that matter. So a good opportunity, good opportunity for a directional move on Caterpillar. Its RSI is broken up. At least it was above 60 earlier on Friday. It was above 150 as well on the CCI. When you look at the DMI pattern, above 25. The negative is not below 20 yet, so we still have a pretty low ADX, which means you're still kind of in a state where you can start a trend because of how low the ADX is. Looking at the Ichimoku cloud, you notice that again we had a bearish trend, we ended that bearish trend, and we haven't started a bullish trend yet, but the rate of change has turned positive finally after being strongly negative. The green lines, we're above the green line, we've crossed below, we're still below the cloud. So we're not that, not as strongly bullish yet. But the nice thing is here, when you look at the Bollinger Bands and the Keltner channels, we have closed not above the upper band, but we were flirting there with the upper Keltner channel, really pushing up against that with some positive momentum, finally moving in the right direction. So what I decided to do on this one, considering the bullish momentum in the markets, is doing a little bit of an aggressive long call vertical spread, selling to 280, buying to 270. It puts my target on the edge of 1 standard deviation, so it needs a pretty decent move to the upside. But remember, we're breaking the 50-day. You're getting dark green shading in a green line. You're getting a pretty aggressive move right now. And so here, let me get rid of this chart. So we position size smaller than what we normally do. We usually go, because it's a relatively aggressive trade, we usually go to $500. We went a little bit less than 400. But we are a really aggressive return to the upside, well, more than 4 to 1. So it gives us a good opportunity for reward if it works out, with very, very low risk, obviously if it doesn't, for a good directional move to the upside. If Caterpillar, remember, the S&P is at new 52-week closing highs, so Caterpillar is way far behind. If it starts to play catch-up mode, then we should be able to take advantage of that. All right, with that said, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Take advantage of, or hit that like button, comment on the video. Join us at marketscholars.com. Use that Black Friday code that we have going through the rest of the weekend. Cyber Monday code, but the Black Friday is the actual code to be able to get that 20% discount. And then again, follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.